Hello everyone, my name is Shivani Gurjar. I'm from SADHAN. And before we start the video, we as a SADHAN team want to give you a warm wishes for this Diwali. May this Diwali bring a lots of joy as well as prosperity to you. And on this same note, we have arranged today's podcast for you where we talk just about that prosperity aspect of Diwali. And to help us navigate through this, we have our guest today, Mr. Tapan Patel. Uh, Tapan sir has a wide experience of over 15 years in the markets, the market research segment, and he specializes in commodities, especially like bullions, metals, and energy, etc. And he's been associated with Tata Management since September 22. And we are very, very happy to have him on board, especially on our Diwali episode. Welcome, sir.
Thank you, Shivani, and thank you for having me here. It's a pleasure, and wish you and all viewers of SADHAN a very happy Diwali and prosperous New Year.
It's a pleasure for us, sir, that we could have you today on this auspicious day. So if you're okay, sir, can we start with the questions for the day?
Yes, please, sure.
So, sir, first things first, just tell us why should one invest in gold? And before you go into this, I just want to tell our viewers, since it's Diwali and it's that special time of the year, we have arranged this podcast which dwells around gold, which is one of the most common and very famous commodities that we as Indians like to invest in on our festive days. So, yeah, sir, over to you.
Yeah. So, people in India or in all over the world do invest in gold since years. I mean, it goes back to centuries. When there is a barter system, then again precious metals came into existence, and people were exchanging gold and silver as a precious metal in a form of currency. So since then, this trend has started of investing in precious metals, especially in gold. And then comes the Bretton Woods system, and after end of gold standards, US dollar was pegged to the gold and other currencies. So that's why the traditional investment in gold and the buying from central bank has started the world economy, and that's why people have started more in gold to protect their value of the investment, and also as a diversification of their portfolio. While central banks are buying gold and investing in gold because they have to protect their foreign exchange reserve, because the gold is pegged against US dollar. So that most of the trades happening currently in world, almost 50% are happening in the dollar trade. That's why to protect their foreign exchange reserve, central banks and large organizations are investing in gold. In India, people are culturally associated with gold. We buy gold and invest in gold to protect our future. Also, to in the form of gifting our next generation, and on the auspicious occasions like Diwali, Pushya Nakshatra, Akshaya Tritiya, we invest in gold. So that's why people tend to invest in gold over the longer term, and also a part of asset management.
It just comes as a traditional value for us, which like goes on through Indian generations to buy gold on such days. So my next question is, what are different ways to invest in gold?
Yeah. So apart from traditional investment of physical gold, buying ornaments and jewelries or coins and bars, currently we have more options available to invest in gold. We have gold ETFs, we have digital gold, we have several gold bonds. These are the products right now available for investing in gold. So investors can choose among these options as per their financial goal and risk adjustments.
Okay. So, sir, are gold prices inversely related to the stock market? And if that is the case, can gold act as a solid hedge against securities?
So historically, if we see correlation between gold and equities, it's almost negative or flat. So currently the correlation is almost 0.2 to 0.7, 0.3, right? Compared to the other asset class, correlated to equity markets. So gold has lowest correlation with the equity markets. And this correlation changes from time to time. If we see previous scenarios like 2008, when global financial crisis happened, it was inversely correlated. If we see current scenario parity, we have seen in last 1 to 2 years, gold and equity markets have rallied in line, because of the central bank buying and risk factor associated to the global economy. So these parity
Right.
changes time to time. But historically, this correlation is negative, and that's why people tend to hedge their equity portfolio with the gold. Because in inverse scenario, sudden economic downturn or fallout situation, gold protects its value compared to the
Yeah.
equity valuation. If equity markets fall or their valuations are lower, gold protects the its intrinsic value, and that's why people tend to invest in gold as a part of their diversification. So definitely, it's a good hedge again equity portfolio and equity allocation with the gold.
Okay. Sir, on this note, if somebody wants to buy gold, is there any correct time to enter the gold market?
Uh,
Like,
let's say
is it
I will
possible to time the market in some way so that we can buy gold cheaper?
Yeah. So I will part in a two ways. Like in India, people tend to buy gold, as I said, during the auspicious occasions like Akshaya Tritiya, Diwali, Dhanteras, Pushya Nakshatra. That's the one of a time that people think that buying gold in these occasions brings prosperity in their lives, right? So
Yeah.
that is the one aspect. Second is if an investor sees that their equity proportion, equity allocation is higher, right? If they are overweight into equity, then it should good to allocate some proportion to the gold or other asset class. I mean, diversify their portfolio. That is one.
Yeah.
Second thing, if global economic scenario or economic scenario is uncertain, war-like situation is there,
Yeah.
uncertainty is there in the market or equity valuation is high, then also it is a good time to enter in gold, protecting their equity portfolio or hedge their portfolio. So these are the scenario where you can invest in gold uh, according to the market scenario. There is no timing or time to gold investment. But if we see some major correction in gold prices from recent high, or from any high, let's say 10%
Yeah.
correction has happened in gold, then yes, people may think to invest in gold at that time because prices have corrected 10%.
Yeah.
So I will say that investors should look after their portfolio and equity valuation and weightage, and then accordingly should take the decision to invest in gold.
Okay, sir. And what minimum holding period do you suggest so that the returns in gold are optimum?
Yes. So if we see 10 year CAGR of gold, return is around 10 to 11%. And historically, if we see the market cycle for the gold, generally a bull cycle lasts for 5 to 8 years. So I will say holding period should be at least minimum 5 years to 8 years, where you can get good returns from investing in gold. But if we see the current market scenario, we have global economic uncertainty. We have proxy wars, like no economy, no country is going to direct war like situation. Proxy wars are going to happen, so that risk
Yeah.
premium is going to associated with the gold for the longer term.
Hmm.
So that's why we see that gold will have that risk premium added to the prices, and we may see the gold price will remain elevated over the years. Again, that we are reading about the de-dollarization trend. BRICS countries are also thinking of bringing their own currency system. So this will
Yeah.
also bring some, devaluation to the dollar, which will increase the allocation to the gold. Because if another currency is coming into the system, definitely people are going to hedge their exposure with the gold.
With
So,
gold. Yeah.
so these are the factors which are going to support the gold prices over the short to longer term. Right. So as I said, normal market cycle is 5 to 8 years. But if you are going to remain there for the longer term, it is also going to give you good returns by investing in gold.
Okay, sir. My last question for the day is actually related to gold ETFs. Do you view gold ETFs as a relatively less riskier instrument when we compare it to, say, securities or equity securities?
Okay. If we see gold ETF, so gold ETF are backed by physical held commodities. All AMCs or gold ETFs are, backed by physical gold, which are there lying in the vault of the AMC, in the name of AMC. So that's why there is minimal risk of liquidity for the gold ETF, right? And also, as I said, this gold CAGR for 10 years is 10 to 12%. The volatility of gold is, let's say, 11 to 12%. So low risk, return are also medium. If we see the equity volatility, it comes from the 15 to 35. With the return
Yeah.
also comes in the higher range. Equity returns are also higher. So for equity side, there is a high risk, high returns,
Yeah.
right? So if we compare, definitely gold ETFs are at lower risk uh, with the comparison. So investors should also look at this aspect where they want to generate what kind of returns, or if they want to hedge or diversify their portfolio, they can look for these numbers.
Okay, sir. Thank you, sir. This was my last question, and I must say you have a very deep understanding of how gold as a commodity works and a lot of macroeconomic factors that have a bearing on gold. And I'm very glad that you could come and share those insights with us today. We are very grateful to have you on board. Again, thank you from the entire Southern team for joining us today.
Thank you. Thank you, Varian. Thank you, Shivani. And again, wish you all very happy Diwali.
Same, sir. Wish you all a very happy Diwali.